Anshul, what do you make of the market setup? I mean, everything is just going our way. First it was crude, now it flows, and now the recovery in rural India.
Good afternoon, Nikunj bhai. Yes, it's an interesting market. Rural economy has been weak for the better part of the last 4 years. Individual households have been filling their pockets, ensuring that their savings are recovered before they go out and spend. And for that reason, that market has been weak. But we are at a cusp, we believe, at this moment, where this market is likely to turn. Initial signs have been seen over the last 2 quarters in company results. FMCG company after company is indicating that there is a turn in that segment of the market. And what is interesting is that while this market has been going one way and that is up, many of these rural discretionary companies have been, at multi-year lows. So that is where, in our judgment, there is an opportunity where once the rural economy turns and the tide lifts all boats, these companies will be beneficiaries as well. So there are opportunities in this market. Of course, you will have to be a discerning investor to take advantage of those opportunities.
Wondering where you finding those opportunities right now, Anshul?
Um, Aisha, if you look at many of these, say, shoe companies, shoe retailers, etc., I mean, just look at their prices. They've really gone nowhere over a really long period of time. Some of the retailers have rallied off late, but again, those retailers had consolidated again for the last 3, 4 years, after which they rallied off late. Even the FMCG companies, as you may have seen, may have noticed, the index has post the election results, the index has turned, and I think if my memory serves me right, from that day to today, it's up between 15 and 20%. That again tells you that there is tailwinds in that segment. So, in our judgment, all of these pockets are where there is opportunity, and these are while there is opportunity all around, but you've got to look for opportunities where the risk reward is favorable, and that's what we find in this segment.
You were very bullish on manufacturing. Are you now turning less bullish on manufacturing and more bullish on FMCG?
I wouldn't paint that with a broad brush, Nikun bhai. I would say that there are within manufacturing there are still opportunities, but the meat of the market is behind. Most of the money has been made. You will have to work very hard to find that odd opportunity now where there will be money made going forward. I do think that for the smart investor, there is opportunity. He can find opportunity in the manufacturing space, but it's not as easy as it was, say, 1 to 2 years back. It will have to be a stock by stock opportunity going forward. And for that reason, it is not just manufacturing. You'll find that opportunity across the market.
Capex, that's been one theme which has really been dominant all through this entire year, if not before. And we also spoke with Vinay Chatterjee, founder and managing trustee at the InfraVision Foundation, to just really try and understand whether or not there is any pickup in private Capex, and whether the government as well is going to continue with Capex at this current run rate or not.
Thermal, renewable, transmission, distribution with smart meters, pump storage, airports, Jewar, Navi Mumbai. These are all happening sectors. In social infra, if you see healthcare, real estate, and now the announcement of new industrial cities. If you see some marquee announcements, there have been the announcements on chips, on mobile manufacture, on batteries with Ambani's, on digital. There is a boom in data centers. And as I said, there's massive investments happening, announced on chips, mobiles, electronics, batteries, etc. So it is happening. Surprise of surprise, the boom sector is defense. You should actually, analyze the order book of defense companies and the two thrusts that India has now embarked on, which is to substitute imports for domestic manufacture and to push defense exports. The increase in private sector capex from 34.1 to 34.9 is hardly worth going to town about. But the fact is that even that this increase has happened because of the sudden emergence of non-traditional sectors, which has at least led to some degree of positivism. Defense, healthcare, power, very clear, and real estate, of course. It's across India's towns and cities, buildings are coming up, real estate is moving. Nominal GDP is growing at 12%, but the cement sector is even less than nominal GDP growth. Am I right? So therefore, it substantiates the hypothesis that we are seeing a structural change in the Indian economy, structural change in investment patterns, where new sectors are emerging, old sectors are growing at a far lesser space in terms of capex. But the new sectors are not large enough to dominate the overall capex story. Anything to do with traditional and non-traditional power. The companies that are in coal thermal are going to see boom times because there's going to be a demand-supply imbalance in favor of producers. So anything to do with the power sector and renewables, green, of course, is in boom times on investment.
Anshul, when you say that the rural economy is showing signs of recovery, what is the best way apart from staples? Could two-wheeler be a bet? Could consumer discretionary be a bet? Could microfinance be a bet? We always think rural economy means soap, sabun, shampoo. There are more categories than that, right?
That's right. You're right. Consumer staples is definitely an option. Within that, again, you will have to be discerning. There are various sub-segments within consumer staples. You will have to look for the sub-segment which is most sticky. For instance, if you look at, say, air conditioners, air conditioners are a basic necessity now. They're not like a luxury anymore. So when people have monies, they want to first spend on air conditioning and make their lives slightly more comfortable. On the other hand, an ironing rod that people may defer the purchase of. So one will have to look for sub-segments where growth is trending upwards and there are tailwinds. Of course, if you look at microfinance as well, that is a interesting space again, because again, that is a space where valuations remain reasonable. Over the last 1 year, we've seen many of these microfinance companies really not participate in the rally that we are seeing in the broader markets. And growth trends are starting to pick up. They have enough capital on their books. I think that is an interesting space as well, where if growth picks up, as we anticipate it will, then there will be upsides on valuations and risk reward remains favorable. So you're right, multiple sub-segments within the rural economy where one can make decent returns on a risk reward basis.
Strategies in this market. One, you move out of high beta, high momentum, maybe those richly priced consumer, richly priced fintech stocks, defense stocks, and move into defensive and staples. And the other idea is that you buy these stocks maybe on a bad patch, maybe on a bigger decline, and sit on cash. What is a better strategy? Do you think the leadership in the market is changing, or cash is a bad idea in this market?
Depends on who you are. If you are an individual shareholder, individual investor, then for you, absolute returns becomes, or an absolute return strategy is what you follow. And in that event, since you've made so much money over the last few years, sitting on cash may not be a bad strategy. But if you're a professional portfolio manager, then your aim is, of course, to maximize alpha over the index. And in that context, holding cash can be a double-edged sword. It may work for you, it may not work for you. Hence, in that situation, it may be better to not hold cash, but hold cash proxies. For instance, large caps, hold defensives in large caps, things like that, where downsides may be limited. So that is a strategy that one could follow. Although, if you ask me, and what I would do, typically I'm someone who follows many of the things that Druckenmiller says. And one thing that he says is that when you're having a good year, the tendency is to book profits and hold cash or be defensive. But it is then that you should be stepping on the pedal and going for the home run. And given how this year has gone, the tendency by now is to really hold cash, take some profits off the table. But I would say that if you are again a smart investor, this is the time to actually press on the pedal because between now and year end, you may see certain segments of the market deliver outsized returns even from here.
Very interesting thing. I mean, all of us love to know more about Stanley Druckenmiller and his style. And if we are talking about the grand finale of putting the metal pedal to the metal, and if the last hurrah in this market left, where is that going to get captured, and what is the best way to capture it?
Nikunj, I don't think that there is any one answer to this. I would modulate the answer in two subsegments. One is that first, you've got to be cautious in segments, like you rightly said, in segments which are overheated, where there is excessive interest from the markets. Fintech, for instance, may be one of those segments. Defense clearly is one segment where there is excessive interest. There are other segments like railway PSUs where there is a lot of interest. These are spaces that one will have to be slightly cautious in. However, there are other pockets, as I mentioned, discretionary rural-linked companies, ethanol-linked companies, alcohol-linked companies, certain FMCG companies, where even media, for instance, and certain segments within media where there isn't significant interest. Those are segments where there will be money made between now and year end. Even logistics, I think that within that there are very interesting opportunities which will generate handsome risk-adjusted returns going forward as well. And I'll give you an instance, Nikunj, if you give me a minute, and I'm not pulling you too far. Look at the last week itself. For nearly 1 year, you had alternate fuel companies go down because of some government action, which was that they had taken away broken rice as raw material for these ethanol companies. Now, one decision of the government to allow this broken rice to be purchased as raw material has re-rated these companies immensely. In fact, some companies are up 40% in just 1 week. My point being that if you are in the right pockets, even a market which is stable to going nowhere, you will find opportunity and where there will be money made. Even a bear market is a very narrow bull market. If 1,000 stocks are down, there will be 50 which will be up. So for you to be to be identifying those 50 is really the game. And that's what I think. I've named some segments. I think that there are opportunities in this market to make money for smart investors.
About 13 minutes left. I'm going to go back to Naresh and get some ideas. Naresh, it's turning out to be not ugly, but a very non-inspirational day. And for the first time, you've not really taken advantage of global cues. And Naresh, frankly, the market, whichever way you look at it, Nifty has been just hugging on to a flat line from last, 6 weeks almost now?
So it's been 6 to 8 weeks, say mid of July, we hit 24,800, 25,000 mark. And we are now almost in mid of September, and we are at the same place. We got this one crack during the yen carry trade. And if you look at it right now, the yen is below those prices and we are still much higher. So, but we've gone nowhere in terms of the index. But there has been a huge, say, divergence in terms of stock price movements. So you have PSU banks at election day lows. You have the Nifty IT up 15 to 25%. You have the pharma up 25% from those times. You have the Nifty FMCG up 15%. So these three sectors were not in the reckoning in terms of, say, election beneficiary, etc., contrarian bids that have gone up. And you have defense, PSU banks, capital goods, which have corrected 10 to 15%. So there has been a huge divergence in terms of leading and lagging sectors. And in between, you have banks which have gone nowhere for many months together. So for now, it becomes a boring market because there is no follow-up price action in any of the moves. Even the trending moves have been slow and steady. So pharma has been slow and steady. You have insurance, which is slow and steady. FMCG is slow and steady. We are not seeing moves wherein a stock moves up 8-10% in a day.
Okay, that's the take coming in on some of the stocks. In the meantime, just taking a look at the pressure points as well. Naresh, we haven't talked about Tata Motors specifically. I mean, it's a huge crack on the stock. It's down about over 6% right now in the futures. Big breakdown. Do you see some more follow-through selling coming in the coming days?
So after today's crack, it makes it more clear that the momentum has shifted. Until now, it was sideways. We had two false starts around that 1100 to 1150 mark. Now closer to 900, 950 is the major support, which is where it bottomed out in the last 6 to 8 months. So for now, at current levels, not very interesting. Would wait out for further declines and maybe look out for a bounce back trade from 900, 950 mark.
Better off avoiding global sectors because the selling in crude, decline in commodities, crack in bond yields, Fed cutting interest rates, this cannot be in coincidence. I mean, if one read in between lines, this is a clear sign that today or tomorrow a slowdown concern will hit us.
Is that for me?
That's right.
That is right. Clearly, there are signs of slowdown concerns. However, I am one to not really take market calls basis with the macro. I still recall that in March of last year, when I was speaking with fund managers across the industry, everyone was saying that this is the small and mid cap segment of the market is heated up, and so one should shift to large caps. From there to now, we've seen nearly 70 to 80% rally in the small and mid caps. We don't have market moves in our control. The only two things that we have in our control is buying quality names, companies which are healthy in their current operations and where the future looks bright, and buying those companies at reasonable valuations. Thereafter, what happens in the markets is beyond our control. And definitely the macros can work one way or the other. On a day, you can get the same news making the markets react in a different manner, on another day, the different manner. So I think that we should really focus on those two aspects, buying quality at reasonable prices. And then if there is any volatility in the markets, then just bear it. Of course, asset allocation is something that each investor should do, and that will allow the investor to buy more if there is volatility. But I'm not one for taking market calls basis the macro.
So you will not assume that the world is going to hit a speed bump and it's time to cash out. You would stick to your positions and you would stay invested. But what about global facing sectors? Would you, if you have invested in metals, let's say pharma or IT, would you stick to them as well?
I would definitely. I'm positive on the pharma space on a stock by stock basis. I think that there even the recent Biosecure Act in the US will throw up a lot of opportunity for Indian companies, US companies. The Chinese CDMO companies are between 20 and 30 times the size of the Indian industry. So even a 10-20% shift from there to India will mean the industry doubles. I think that there is significant opportunity for India in the CDMO space, the pharma space. On even in IT, I would say that IT in general looks expensive. I think that leading companies which used to trade at between 15 and 20 times earnings now trade at between 25 and 30 times earnings. I think that space is expensive. Of course, if you're wanting to hide, then that is you want to be in a defensive space, then clearly that is the space to be in. But by and large, I think that space is expensive. So I wouldn't enter a space again basis the macro outlook for that space. I would enter it if the risk reward is favorable, valuations versus growth is favorable to me as a buyer.
Just earlier today, we were also chatting with Sandeep Tandon from Quant Mutual Fund, and here's his opinion on the markets, and of course, a lot of other concerns regarding, the regulatory concerns regarding the functioning of his mutual funds. Here's what he had to say.
current quarter between July to September will be the most volatile quarter in the FY 2024. Okay. And when we saying that why it should be volatile, because we have been talking about cross asset, cross market volatility should spike, and the background of geopolitical volatility, currency volatility, which means world is not going to be stable in this period. And that's one of the precise reason in last 3 months, our portfolio, if you look at, is more skewed toward defensive side. And we still maintain that this cycle has still not ended. Let's say FMCG is a space which has been underperforming for a while. Okay. That's a space we have built our exposure. Valuation was not cheap, but they started trading in a neglected territory, and hence that was the play. So is the case with pharma, and so is the case with insurance, and so is the case with some of the healthcare space. So these are the areas which we remain very constructive, and I'm saying that even sometimes you have to underperform a bit. It should be a part of a strategy, but let's play safe when we see data points are showcasing that things are going to be more volatile. So I like to play safe through these sectors. Business is back to normal. Okay. We are seeing continuous inflow. You have seen that recently we have crossed 1 lakh crore mark. So we are one of the, I don't think in any mutual fund industry, anybody has grown this sort of size in 4 years. So that's a big achievement. And I think that credit goes to a lot of retail support, which we got because we are predominantly a large retail house. So a lot of support came from tier 2 cities also, and B30 beyond 30s also. So it's very important that whether Quant brand has been established among masses, answer is yes. It's a very trusted brand which we have created. And what is very important is an asset-light model we run without any branches, without big sales force. We have able to generate. So this business is all about performance, performance, and performance.
Okay, some words coming in from Sandeep Tandon. In the meantime, as we begin winding up for the day, let me also get in some BTST trades. Naresh, what's on your buy today, sell tomorrow list, or is it the other way around?
Still a buy today, sell tomorrow list, more of defensives. First is a buy on Max Financial Services, new 52-week higher, very close to an all-time high. A stop loss at 1135, target price of 1180. Second is a buy on ITC, again hit a new all-time high today, stop loss at 510, target price of 525.
Okay, those are some BTST ideas there. Look at Bajaj Auto though. That's the one which is scaling up quite nicely. Paints, of course, as a segment is looking very good. Anshul didn't talk about that. You know, paints as a category has really been subdued ever since, you know, Birla's gotten into the game. There were a lot of heightened concerns around competition heating up in the sector. And of course, valuations also were bloated. Now they seem to be coming out across the board along with the big tailwind of crude from that sort of hibernation that these stocks were in. You think there's merit in looking at these?
Aisha, in my experience, for stocks to rally consistently, they need to show revenue growth. Minor moves can happen because of margin expansion, but for stocks to continue the rally that they've seen in recent times, revenue growth has to pick up. And in this space, I fear that there is going to be intense competition. There are 2 large players who are entering this space, who are only just entering this space. And, you know, in terms of quality, I don't think that there will be much to differentiate between one from the other. And the pricing differential can lead to many buyers moving away from the incumbent players to these new players. You know, the incumbent players trade at very hefty margins, 20+% EBITDA margins, and which gives them around 30% ROEs. A little bit of compression in those, you know, metrics can lead to multiples compressing meaningfully. And I don't think that the raw material pressure easing off is something that will be a consistent factor for these stocks to rally. That may be a trade that may play out for some time, but thereafter it will have to be volume growth for each individual company for the stocks to rally, which in my judgment looks some time away even from here.
Okay, Anshul, we'll let you go on that note. Naresh, good to have you on the show as well.
If you like this video, then like, share and subscribe to ET Now.